I now hand the conference over to Mr. Chetan Shah, Managing Director of Sumitomo Chemical India Limited. Thank you, and over to you, Mr. Shah.
Thank you. Thank you very much. Uh, Hello, everyone. Good afternoon. Welcome all the participants to this call. Uh, there is an overwhelming response to this call, and I'm grateful to everyone who has spent their valuable time and have joined here. So, uh, let me begin today by introducing uh, the members from the company side who are present on this call. We have Mr. Sushil Marfatia, Executive Director, Mr. Masanori Uzawa. He is joining us from Tokyo, Non-Executive Director. Mr. Kunal Mittal, who is a Vice President, Senior Vice President of Planning and Coordination Office in Mumbai. Mr. Praveen Desai, whom many of you know, our Company Secretary and Compliance Officer. Mr. Anil Nawal, Chief Financial Officer, and the colleagues from SGA, our Investor Relations Advisors. Having said that, let me begin by saying as to why I feel personally that we are in a great space in this business of agrochemicals, and which is likely to, give continuous growth because of my belief in following three reasons. Number one is that we in India have very, very low pesticide consumption per acre or per hectare, as you may call it, as compared to the world. We have hardly zero point 0.8 grams per hectare of consumption of pesticides as compared to 7 kilos in Europe or 7 kilos in USA or 11 kilos in Japan. I mean, China itself is around 9-10 kgs. So we have a very low consumption, and there is a tremendous scope to increase these volumes in our Indian agriculture. Also, a reason that today, if you see the quality of vegetables or quality of fruits for domestic business, domestic consumption, the level has changed. The consumers are asking for a much better looking quality, much better taste, much better finish, and all this also, induces a farmer to use better molecules and proper molecules to give that product in the market to stand the competition. Also, the export market itself is of vegetables and fruits also requires the same inputs of agrochemicals. Another important point that I would like to make all of you aware of is that now I have completed my 20 years of journey with Sumitomo Chemical Japan, and I have seen Sumitomo and their style of working and their philosophy of conducting a business, etc., from a very, very close angle and for many, many years. And this itself has been a great learning for me, and to incorporate that thinking and philosophy into our Indian operations have helped us a great bit in making the company what it is today. If I talk about the three most important aspects of philosophy which are matching between India and Japan, are the following. Number one is the safety in operations. I think this is a very fundamental philosophy, and both in India, we have nurtured that, and even Japan has very strong, you know, point of view on safety in operations. So we don't compromise safety. We don't compromise our plants in the smallest way. So this has been a very good thing. Second most important thing, which indirectly helps our organization, is our belief in respecting the human assets that we have. And we it is very common to find 15 years, 20 years, 25 years of services of many people in our organization. And this philosophy also is very close to Sumitomo Japan's hearts and minds. So this is a very important point for our sustainable position in the industry. And the third important philosophy match is that we are not only working or running this company for making profits. Of course, that is an important part of it. But while we make profits, we must see and ensure that the society around us, by and large, also benefits from our operations. So, be it CSR or be it upgradation of the society around you in any whichever way you can, I think that is very close to our heart. And I think even the God is looking after us because of our this aspect of running an organization. And we are very clear that we will ensure that the society by and large should benefit from our operations. So these were the few initial thoughts that I had. Of course, there will be a lot of opportunity going forward during this call to talk about the real figures or real business or whatever you might want to know. But I will now very quickly ask Kunal to share something about the company. And or before that, I think I should request Uzawa-san to come in, and after that, Kunal will come in. So Uzawa-san, can you please share some thoughts of yours from the Sumitomo Chemical Japan point of view, how you see India, how you see our Indian operations, what is important for Sumitomo as a parent company, and how you have decided to support Indian operations.
Sure. Thank you very much, Shafam. And then, thank you for having me in this meeting. This is a great opportunity for me to connect with the supporters of Sumitomo Chemical India. First of all, I'd like to highlight that we, Sumitomo Chemical, have been very positive on the growth trajectory of Indian agrochemical industry. And the idea of consolidating our presence in Indian agrochemical space is to drive operational synergy as well as provide flexibility to address growth opportunities in the domestic market as well as the global agrochemical space. And with our robust product pipeline coming from our strong R&D effort over the years, and the manufacturing base in India strengthen our competitive products in the global market. And SCC, Sumitomo Chemical Japan, will continue to support Sumitomo Chemical India to achieve market leadership in Indian market through its strong portfolio of agri-solution products and stay confident of its growth potential. That's my view on the Sumitomo Chemical India business in general. With that, I will hand over to Kunal to share more information on Sumitomo Chemical India business.
Thank you, Mr. Shah and Mr. Uzawa. Before we talk specifically about Sumitomo Chemical India, let us summarize a little bit briefly about the industry. As you all are aware, the agriculture and related activities such as agrochemicals were classified under essential category by the Government of India, and accordingly they were least impacted by the COVID-19 related disruptions. So far, the spread of COVID-19 has been limited in rural areas and did not impact the demand of agrochemicals. Except Northwest India, all regions of Indian country received higher than normal rainfall in the monsoon season, which just finished. There were good rainfalls, especially in the month of July and August, which are very important and critical for the kharif crops. The monsoon was very well spread, both quantitatively and qualitatively, and this led to higher kharif acreages and a record increase in the sowing activities. The coverage area also increased by approximately 4.5%, which is a very encouraging sign. In some regions, due to continuous rainfalls in the month of August, we saw some delays in spraying activities. However, overall, the weather trends and the good rainfall were very positive for the agriculture sector and agrochemical sector in last few months. According to Indian Ratings and Research (IRC), in the current financial year, the agriculture sector is expected to grow better than the overall economy for the second consecutive year in a row. It expects the Indian agriculture to grow at approximately 3.5% year on year in the current financial year, compared to the overall economy growth forecast of negative 12.2%. How the numbers actually pan out throughout the year is yet to be seen, but these are the best estimates being provided by the independent agencies currently. One more encouraging sign is that the water levels and the reserves on pan-India basis are much higher as compared to the last 10 years average levels, and thereby this is setting up a very good base for the upcoming Rabi season. The farm exports of the agriculture produced from India also witnessed significant increase by approximately 43% in the first 6 months of the current financial year, which is also one of the key focus areas from Indian government side, as stated by our Honorable Prime Minister. The increased government focus on the rural income as well as the recently introduced farm reform bills and the laws have created increased value in the agriculture sector, which are expected to boost the growth of the sector in medium to long term. This is also expected to provide the farmers with the access to the high quality inputs such as seed, fertilizers, agrochemicals, and overall these reforms should benefit the farmers and also expected to be advantageous to the Indian agrochemical sector. Some of the other industries in addition to the agriculture which we operate into includes animal nutrition, environmental health, household insecticides, and public health. These industries faced certain demand-related challenges in the initial few months of the current year. However, the demand situation has been reviving over the last few months and is expected to revive to a large extent in the coming few months. On the supply side, there were some constraints in the initial few months due to closure of our plants, and then production levels have revived to a large extent over the last few months. We also face certain challenges and constraints in terms of availability of the input materials, and our suppliers also face certain challenges, especially related to the packing material side. So with this, I think we can summarize the industry part and we can provide you a little bit more specific information about our company, Sumitomo Chemical India. Sumitomo Chemical India, as you all are aware, is part of a very old, 100 years old Japan-based Sumitomo Chemical Group. And as you might be aware that Sumitomo Chemical Group is a very well diversified R&D focused chemical company and is among the leading global innovators in the agrochemical space. Our esteemed parentage provides us distinctive advantages like access to high-end R&D infrastructure, proprietary specialty product portfolio, global distribution reach, technical expertise, and various other benefits. Being part of the Sumitomo Chemical Group, as Shasan also explained, I think innovation and sustainable growth are one of the fundamentals objective of our company, and also we have a very stated objective of benefiting the Indian farmers, and we continue to achieve that. We are primarily engaged in the manufacturing and sale of specialty and generic agrochemical products, and we also undertake distribution of animal nutrition and environmental health products. overview of last 20 years of our evaluation in India, of Sumitomo Chemical India, and last 10 years of the extraordinary growth journey which we witnessed has been summarized on page 17 of the investor presentation, which you can refer during your free time. As you are also aware, in 2019, we completed the merger of our two Indian companies, which were Excel Crop Care and Sumitomo Chemical India. The combined entity, Sumitomo Chemical India, is one of the most diversified agrochemical players in India. Within the agro solutions business, we are very well diversified because of the multiple segments which we operate into. In the specialty segment, we distribute SCC's global proprietary products in Indian market and have one of the deepest distribution reach, direct farmer connects, and skills to generate demand for innovative, high value-added products at farm level. In the generic segment, we have a very robust product portfolio of several premium generic products with technical manufacturing capabilities, well-known brands, and a reasonable distribution reach all across India. In exports market, we have higher proportion of branded exports of our products manufactured in India, especially to African markets, and we also undertake exports of the bulk technical products in various global markets. We also manufacture proprietary specialty products and exports to our group companies within Sumitomo Chemical Group. Currently, we have one such product which we are manufacturing in India and exporting to Sumitomo Chemical, and we are looking to expand this particular portfolio in the years to come. The merger, which we just spoke about in 2019, which we completed, it also created and integrated two successful individual platforms, and they have further strengthened our market position. We are also able to leverage the diversified product portfolio which we have, and we have, as I explained, very robust and well covered distribution network. The revenue and the cost synergies arising out of this merger have started coming in and should boost our margins over a period of time. The undivided focus from our parent company SCC will also enable greater focus and will drive our expansion in the future. We plan to launch several unique products from our parent company's portfolio in Indian market, and it will strengthen our domestic product portfolio. We also plan to boost our exports by leveraging our parent company's global presence and distribution network, which will be supported by our manufacturing expertise and the cost-effective base in India. We have 5 manufacturing facilities in India, in Bhavnagar, Kajod, Tarapur, Vapi, and Silvassa. We have 3 fully equipped DSI approved R&D facilities. Our R&D team largely focuses its efforts towards launch of off-patent products and also evolution of efficient processes. Our R&D capabilities include synthesis, technical products, and also formulation development. We have approximately 75 member strong R&D team, out of which 10 plus scientists have PhD qualifications and more than 15 years of experience in agrochemical R&D initiatives. Currently, we have approximately 190 brands across complete agrochemical value chain, with several brands being trusted by farmers. We have a fairly robust distribution network with over 13,000 plus direct distributors, providing us a reach to large base of dealers and retailers across the country. We have a strong brand presence with market-leading positions across various product categories, and we also have a branded products constituting to about 81% of our domestic revenue. We have also growing presence in African markets, in other countries in Asia, and also Latin America, and various other countries across the world. In terms of the future product pipeline, we have a very robust product pipeline for the future. In the current year, we have already launched 4 new products. 3 of these are insecticides, and 1 product was into plant growth regulator, which we call as PGR segment. We have aggressively promoted these products in the current year in the domestic market, using the digital tools to be in a situation when we cannot directly connect with the farmers at physical level. We have we have leveraged the digital presence which we have to launch some of these new products in the current year. We also have several proprietary specialty products of SCC under various stages of evaluation, and we expect to minimum launch one new innovative product from SCC side in Indian market every year. Our Indian R&D team is also developing several off-patent products which are expected to be off-patent in next few years, and we have a good potential and a strong pipeline for the future products coming from this particular bucket. In addition, one more interesting theme on which we are working on is related to the combination molecules, wherein we are mixing some of the SCC's proprietary molecules with some of the generic molecules being manufactured by SCIL in India, and we have identified 9 such combination products for further evaluation, and which have shown very good commercial potential to be launched in the global markets. We also have a strong pipeline of some other technical products from SCC's global portfolio to be manufactured in India, and many of these products are at various stages of evaluation. We continue to see demand across our product portfolios, whether it is insecticides, herbicides, fungicides, PGR, and metal phosphides. We have great focus on the disciplined sales by monitoring the ground level liquidation and the consumption pattern, which also helps us in the better forecast and also better collections. For the future, we aim to focus more on the high growth, stable and high profitable segments and products such as herbicides, PGRs and biorationals. We have some very good products in all these segments, and our future pipeline also has some of the products in these segments which we expect to be able to commercialize and achieve growth. We plan to increase contribution from PGR segments for both Kharif and Rabi crops, basically. So this will also help us reduce our seasonality in the business. We typically invest approximately 15% of our consolidated EBITDA every year for upgradation and capacity expansion to cater to the robust demand both at the domestic and the export side in the agrochemical space. In addition, depending on the additional manufacturing opportunities, we may invest in expanding manufacturing capacities, depending upon the situation. With this now, I think we can now cover a little bit about the financial performance of the quarter and the half of the year which we have just closed. And I request my colleague Mr. Anil Naval, CFO of our company, to please take you forward through the numbers.
So we run through our quarterly performance. We recorded 9% year-on-year growth in our revenue from rupees 830 crore in Q2 FY20 to rupees 902 crore in Q2 FY21. The gross profit for Q2 FY21 grew by 24% to rupees 360 crore as compared to rupees 290 crore a year earlier. The gross margin for the quarter saw an improvement of more than 490 basis points from 35% in Q2 FY20 to 39.9% in Q2 FY21 on back of better product mix and prices. EBITDA came at rupees 219 crore in Q2 FY21, which is up by 37% as compared to 160 crore in the same period last year. EBITDA margin in current quarter improved by 501 basis points to 24.3% from 19.3% in Q2 FY20. The increase in EBITDA margin was primarily on account of improvement in operating leverage due to better product mix and prices, improved operational efficiencies, cost optimization, and merger synergies. Profit after tax witnessed a growth of 24% at 158 crore in Q2 FY21 as against 128 crore in the same quarter last year. Profit after tax margin stood at 17.5%, which was up by 209 basis points vis-a-vis 15.4% in Q2 FY20. Now let us talk of H1 FY21 consolidated performance. Revenue from operation in H1 FY21 stood at 1550 crores, which is up by 7% as compared to rupees 1455 crores in H1 FY20. In H1 FY21, domestic agrochemical revenue contributed about 87% of overall revenue, with export contributing the rest. In the first half of this financial year, insecticide contributed about 47% of total revenue, while herbicides, plant growth regulator, and fungicide contributed about 21%, 12%, and 10% of total revenue respectively. EBITDA witnessed a growth of 38% from 244 crore in H1 FY20 to rupees 338 crore in H1 FY21. Our EBITDA margin expanded by 498 basis points to 21.8% from 16.8% in H1 FY20. Profit after tax for H1 FY21 witnessed a jump of 31% to rupees 237 crore from 181 crore in H1 FY20. On a working capital front, during H1 FY21, we had a collected rupees 1543 crore as compared to rupees 1320 crore, which was collected in the same period last year. In this period, the collection number is at similar level to our revenue. The increased focus on collections enabled us to improve our working capital cycle further to 42 days in Q2 FY21 from 54 days in Q1 FY21. The improvement in working capital cycle led to improvement in cash flow for the period. The net cash flow from operating activities for H1 FY21 was rupees 541 crore as compared to rupees 167 crore for the same period last year. Our balance sheet continues to be strong with a zero debt and a cash and cash equivalent and liquid investment of rupees 680 crore as on 30th September 2020. The robust balance sheet provides us comfort to evaluate various future growth opportunities.
Thanks, Anil. So now we can open the floor for the question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Also, we'd like to request participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Sudarshan Padmanabhan from Sundaram Mutual Fund. Please go ahead.
Yeah, thank you for taking my question. So my question is on the cost. So if I look at the gross margin this quarter, I have seen a substantial improvement both on a year-on-year basis and Q-on-Q basis. If I look at the mix, I mean broadly there is I would say that your herbicide is up by about 200 bips, and probably insecticide is down by about 100 bips, and even from a specialty generic point, I mean there is a 100 bips swing here and there. The only thing that I see is the exports, which has sharply come down. So two things: is the gross margins benefit largely on account of the exports coming down, and or is it also because of the cost benefits that we've been talking about? So if you can give some clarity with respect to how much is qualitatively from the cost benefits, how much can continue going forward, it should be great.
No, this is highly sustainable. I think what you have observed is correct, but if you also see that the margins in exports are not less, that has also improved. If you see the standalone export margins. So it is not only that, but yes, there has been a situation whereby our cost of inputs have remained stable. We did not have too much upswings for a number of months in any of the prices. I think the market remained quite stable for our inputs. And secondly, I think due to our product mix, and if you see that our PGR have shown a growth, and our new introduction of one of the main products was also under PGR section. So basically, overall product mix and stable input prices. These two have helped to improve the margin substantially, and which we have been talking about in the past as well, that we will constantly try to improve our margins by changing the product mix, introduction of new products, etc., etc. And that has come true. And this thing, as long as we are having a good pipeline of new introductory products or new introductions, this is highly sustainable model.
Sure. Sir, my second question is on the product, concentration specifically around glyphosate. I mean, now that across the world and also in India, we've talked about several governments have talked about glyphosate use that needs to be restricted. From the pipeline point of view, given that the parent has got such rich pipeline, I mean, currently, what is the kind of revenue concentration from glyphosate, and probably in the next 2 to 3 years, do we see this, product coming down sharply and kind of addressing that risk in terms of revenue concentration?
So, see, of course, I mean, I will not deny that glyphosate is one of our, very good brand products. And but however, as we have also announced earlier, we have no product which is more than 15% of the thing. So glyphosate will be maybe around 12%, 13% or so, and it is an important product. While there has been a noise about glyphosate and everybody hears that noise, let me tell you that glyphosate is still number one product in the world, and the most developed countries like USA or Latin America or Australia or Canada or any country you see, including Europe, the glyphosate is still on and very, very strongly on. And we feel that in the next round of its review in 22, it will have another 5 years of extension. That is what we believe is likely to happen. So for 5, 6, 7 years, I don't think that glyphosate will be affected. And if we are talking about the replacement, very fortunately, our parent company is, working on some herbicide molecule which can replace glyphosate in years to come. That will not be immediate, but yes, by the time glyphosate cycle gets affected, I'm sure it will be there. So I think we are not as much worried about glyphosate in this time. But if you take this question for what happens after 9 years, 8 years, 10 years, then yes, your question is very valid, and we will have to be prepared for that. And as I said, that we have some alternative possibilities from our parent company. We are looking forward to that.
Sure. Thanks a lot. So my final question is on the mix. If I look at, the product mix still seems to be skewed towards insecticides, and probably herbicides would be the second largest. Given that we also have a lot of PGR, product and, bio-based product in terms of capabilities, how do we see this 47% of insecticides and 21% of herbicides, say, 3-4 years down the line?
In Indian agrochemical industry, you must accept that insecticide plays a very, very, prominent role. And it is not a question of replacing insecticides with plant growth regulators or bringing down the insecticides to that extent. But if you see historically, this, insecticides was a much more than this 50% or so of the industry. And it has come down gradually. That has not come down by quantity, but because other segments have grown from a lower base to a higher base, automatically the percentage of insecticides have come down. But with our agroclimatic condition, I think insecticides will continue to play a very important role. And it is a question of how you replace your insecticides with a little newer molecules. So we are working on each and every segment: insecticides, herbicides, fungicides, PGRs. And the growth in PGR and fungicide will seem to be more because it is at a low base. Insecticide you cannot increase from 47 to 49% or 49 to 51 that easily because it will be a replacement of some of the older molecules. But PGR and fungicide market is evolving, and there will be more and more and more such products coming in. And as I said, with certain dynamics of marketing of agricultural output, as I said in the beginning, that the demand for better product is in fashion, and that is likely to continue to a great extent on a very high level. So all these PGRs and fungicides will help producing that material which is required by the market. And that's why you will see the growth in these two segments.
Sure. Thanks a lot, sir. I'll join back the queue.
Thank you.
Thank you. The next question is from the line of Dhavan Shah from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, you have mentioned that we are working for one molecule for SCC Japan, and we are planning to launch around one new molecule every year for the Japan parent. And apart from that, you are also planning to work for the technicals. So I just wanted to understand about the CRAMS revenue, which is currently into the overall top line numbers, and how big it can be in the next 3 to 4 years based on the opportunities you are looking at right now.
Sir, thank you for your question. But without giving the revenue numbers, I can tell you that we are definitely working on this both the fronts. One is the molecules from Japan. We get in, we formulate, we brand it, and we market it. So that also the trials of a lot of products are coming in. I think we'll have definitely one or maybe two products in production in the next financial year. And we are looking at the work in the field or data generation and whatever it is that is going on in such a way that we should be in a position to get the registration and marketability of that product, at least one product every year for next 3 to 4 years. Of course, there is a caveat to this because registration is always a situation beyond our hands. So maybe in 1 year there will be 2 products, or 1 year the product can be delayed. That thing can happen. But we have planned in such a way that we will be able to introduce some product, whether it is a PGR, whether it is an insecticide, fungicide, whatever it may be. But one product every year we should be able to introduce. And also side by side, we are talking about at least 4 to 5 molecules which we will manufacture in India to be exported back to Sumitomo Global all over the world. And this will not be a typical CRAMS model. This will be a buy and sell arrangement at arm's length. That is the model that we will have. It will not be a typical CRAMS model.
Okay. So under the CRAMS, I mean, you mentioned 1 or 2 products per year. So any ballpark number? I mean, what could be the per molecule?
We are talking about around 4 to 5 such products, which will start. One of them will be started in the next financial year, end of next financial year, or the beginning of 23. And there are other 4 products which will start putting up the manufacturing facility within the next year. So within 1 year, that plant also should be ready.
Okay. Okay. And secondly, sir, about the expansion in the gross margins for this quarter. So you mentioned that because of the changes in the product mix and the benign input cost, there has been expansion. So apart from that, is there any increase in the finished product prices or any, if you can share, which can lead in improvement in the gross margins?
See, the prices have gone up prior to the stabilization of the input cost. And I think in the beginning of the year when the input cost was a bit higher, from that time onward, the prices have started moving up a little bit. And yes, there has been some products or some areas where the prices have gone up slightly, but that is, I think, it is not an extraordinary profit. You see, suppose you talk about, say, a product like chlorpyrifos or a very, very generic product. I think the prices went up of all these products, which was very well deserved and which was selling sort of at a very, very desperate prices earlier. So it has just improved to normalcy. It is not that the normal prices have gone much higher. It is not that scenario. So it is not that the product was not available or it was in short supply, so we got an opportunity to increase the price. The prices which has gone up from a sub-level of pricing to a normal pricing. That has definitely happened.
Right. And sir, lastly, about the cash and investment, which is roughly around 700 odd crore right now in the balance sheet. So apart from, are we looking at any big capex or maybe any inorganic opportunities which can improve our return ratios going forward? Because I think over the period of time, I think will based on the product launches, the innovative product launches, and maybe a visibility of expansion in the margins, we'll be generating decent free cash flows over the period of time. So any future capex plans, if you can share?
Yeah, so we have not yet got these capex plans approved by our board, but as I said that if we are going to manufacture these 4 or 5 molecules for exports, then obviously that substantial capex will be required. That will be over and above our 15% of EBITDA capex, which we normally have to improve the capacities and efficiencies. Apart from that, there will be a substantial investment required, which will all come from within our own resources without incurring any debt. And to answer your second question, yes, the cash can be used for inorganic growth as well. We are wide open for that, and we are having our eyes, ears, everything to the ground and looking for such opportunity. And if there is any opportunity that we can get, so we can surely, we are very, very eager to capture that opportunity.
Thank you. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. The next question is from the line of Alok Ranjan from L&T Mutual Fund. Please go ahead.
Hi, good afternoon, sir. So my question is related to the acquisition of Newcom business, the Latin America business that was done by the Sumitomo Japan. So just wanted to understand what can be the opportunity size for Sumitomo Chemical India, given there will be some registration that needs to be done, and also the fact that right now a lot of sourcing might be happening from China. Further, the fact that Sumitomo has only manufacturing facilities in Japan and India. So how big this opportunity can be for Sumitomo Chemicals India, and how our export mix will change over the next 3 years, right now, which is around 20% currently?
Okay, so I think we are not looking at percentage of exports. I think we want in both the segments, exports as well as domestic. So you may not, maybe 1 or 2% here or there, it may happen. But say it can grow in both in terms of percentage, then you may not see the percentage change between export and domestic, but you will see growth in both. And coming back to this Latin America opportunity, yes, it's a great opportunity for Sumitomo Chemical India. I think it has been a great buy by Sumitomo Japan of this company. It has put them in a very, very strong position in that geography. And I think we have low-hanging fruits to encash the opportunity, as well as a little bit of a long-term situation. So, say as for example, we have already the registration in Brazil and Latin America that for four of our molecules. So I'm very happy to inform that one of the molecules which we are not manufacturing at all, that is being consumed by New Farm in Brazil, and we have just received our first order of that molecule, which will start in December this year, and export out that quantity. And this is just the beginning. It's a small quantity of 40 tons, sort of a trial order, but this can be a big opportunity in the coming years to take it to maybe 150 or 200 tons. So that type of opportunities are there. Second type of opportunity is our existing exports of, say, chlorpyrifos to Brazil. That can have a very big jump because New Farm is consuming large quantities of this particular product, and which we can now encash. Of course, it has to be at arm's length, and all that goes without saying. And we'll have to compete China to export out those products. So we have products like that which we can increase the volume. There are products which we can restart. So yes, it is a great opportunity, and we are looking forward to a very, very strong tie-ups with New Farm or Sumitomo Brazil going forward.
Got it, sir. Thank you. Sir, my second question is related to CRAMS, where you said that one product we will be trying every year, and the other opportunity that you mentioned is 4 to 5 molecules will be manufactured for Sumitomo under buy and sell model.
Sorry, let me correct. Let me clear the misunderstanding. I said we will introduce one product every year, which we will bring in, that is Sumitomo's molecules or Valent Bioscience USA molecule. We'll bring in those products, formulate it over here, brand it, and market it. So that is at least one product every year. But
got it.
This type of a situation of manufacturing technical in India to export it out to Sumitomo Global, that is not one in every year. That will be one will be definitely there next year. But other 3 to 4 products will all come at one time. Maybe
got it, sir.
22 or 33. It will come all at one time, not one every year. Yeah.
Okay. Sir, coming to CRAMS, I have seen that Sumitomo Chemical Japan is having tie-up with other CRAMS technical manufacturing companies in India. Is it like finally this where the Sumitomo Japan is sourcing from other companies, this opportunity will fall into Sumitomo Chemical India because we are having our manufacturing base? So rather than sourcing from other companies, will it be like it will be a natural opportunity for Sumitomo Chemical India to manufacture that for Sumitomo Japan?
We have not discussed this, frankly, but I think there is only one product that Sumitomo sources from India, and that is fungicide, and a very, very typical technology which they have worked out with this one company. And it's one fungicide, I think, and not a very large volumes. And we have really not talked about disturbing that. But going forward, if Sumitomo wants to make any product in India, that will definitely come to us first. So I don't think that there is a talk about and rightly so. Why we should disturb any ongoing arrangement. So we have a lot of products and we have got a lot of things to do, which we can do without that product. So we are bringing these 4 new products or 5 new products. They are all coming to us. They will not go anywhere else. We will not manufacture those products with the third party.
Thank you. Before we take the next question, we request participants to please limit your questions to 2 per participant. The next question is from the line of Swati Hiru from Ratnabali Investment. Please go ahead.
Hi. In our global presentations, we have given a target that we want to become the number 1 player in India. So how do we plan on achieving that? How do we want to go about it?
All the things that you have is the platform or is the way to go. So you increase your capability to produce new products.
Sorry to interrupt you, Mr. Shah, but we can't hear you very clearly.
Hello. Answer that?
Yeah, sure. Thank you for your question. I think the point which you mentioned, I think this is kind of a stated objective which we have mentioned, that in the domestic Indian B2C branded domestic marketing business, yes, I think our ambition is to take leadership position in India. In last 10 years, since we seriously started B2C branded focus business in Indian domestic market, we have shown significant growth, and we are very, very confident and comfortable that with the kind of a strategy which we have, which is across different segments, different products, backed up by SCC Japan's global molecules to be introduced in India, as Mr. Shah explained, and also due to the good R&D teams which we have in India, which focuses on off-patent segments, we are very confident that we are inching towards our stated targets on an everyday basis, and in years to come, we will aim to achieve that position.
I also wanted to understand, so we talk about focusing on this PGR and biorational space, and my understanding tells me that globally Sumitomo is the largest player in that. In India, what kind of a market share do we have, and who are the other players?
So in the global market, yes, your understanding is right. We have a company in our group which is called Valent Biosciences, based out of US, which is one of the leading companies in this space. Your understanding is right. And in Indian market, we are exclusively distributing their global products in Indian market, which are more focused towards the PGRs and biorational segments. This is a kind of a newer segment in Indian agriculture industry, because to educate a farmer in the specific segments where these products have application is not a very easy task, and it requires a very, very large amount of investments and efforts in terms of showcasing the products, explaining the benefits, and then converting the consumption of these products to a farmer. And we have shown good success in several of the products in the PGR segment which we have launched over last few years, and we will continue to expand that particular portfolio in the future. And in terms of the portfolio, we already have, I think, about 12% of the total revenue coming from this segment, which is a fairly good success and a reasonable level in our view. And in the future, we will look to expand that further.
Thank you.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, Mr. Shah, you did mention that, some bit of, underpricing earlier, coming back to normalized pricing, which is also driving this gross margin expansion. But just taking, if I look across the other companies as well, the gross margins, what we are reporting are still relatively lower than the other companies. So will it be right to say that the full potential is yet to play out and it's still a work in progress, or a large part of the benefit is already there in the numbers?
No, I do not know a factual position on that. But I think I am looking at this market and our whatever we have established ourselves in the market to be quite sustainable. And I really I'm not too sure whether your observation that the margins in other companies in brands in B2C market has expanded as much. I think there may be companies who have shown, because of the CRAMs or because of some other models. But in the domestic market B2C, we have not seen that.
Sir, my question was more in terms of, absolute gross margin. So, 35, 37, 38% gross margins that we are earning, versus the gross margins earned by other companies, not in absolute terms in percentage growth, but more from an absolute point of view. Wherein is there further scope for expansion, or, from here on it will be more like gradual growth?
So it depends on it depends on how many products we are able to introduce, how many new products we are able to get in our registrations through, etc., etc. And if that continues, I think there will be a scope to not only sustain this, but even to do that.
And also just to add here, Mr. Ankur, I think from our side, I think as we have mentioned in the past also, I think our continuous endeavor is to expand the portfolio and the sales of the products and the segments where the margins are higher. And over the years, we have achieved that strategy successfully, and that is a strategy which we continue to work on a continuous basis. And in the future also, within our existing portfolio, if we are able to expand the high margin products slightly more, then the margins can expand. And as Mr. Shah very rightly mentioned, that with the introduction of new products, typically the margins can be further expanded.
Yes, that is true. So our efforts, as for example, to have these combination products, as for example, that is towards that only. That the generic molecule, if the prices are subdued, that if we make a unique product out of that by mixing it or by having a combination, it will have a much better margin possibilities.
Sure. Sir,
effort is towards that. So the continuous effort is to improve the product mix in such a way that it can sustain the growth of margins year on year.
Sure, sir. Fair enough. And on the working capital side, while in the first half we have seen a decent improvement there, your comments there in terms of the path going ahead on that side.
Yeah, so that also is highly sustainable. I think we have worked out internally a model which for the credits or for the recoveries or for the inventory planning or all these things put together has shown that we can achieve this kind of figure. Of course, to improve on this in Indian market is a bit difficult, but even if we maintain this level, I think it would be great.
Okay, great, sir. Thanks a lot and all the best. Thank you.
Thank you. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. The next question is from Amar Maurya from Alpha Accurate Advisors. Please go ahead.
So thanks a lot for the opportunity. So my first question is on the capex front. As you indicated that 4 to 5 molecules for the manufacturing in India will be done. So what kind of the typical capex will be having for that, and what kind of asset turnover ratio we can see into that kind of model?
Well, since I'll ask your understanding in this that since we have not yet even gone to the board for this particular thing, I would not be in a position to answer that. But whatever we have worked out, the plan, that is all very, very within our limits, within our capabilities. Very quick implementation will be done. And as I said, we need not borrow any money for putting up this plant. And I think the ratios will be, investment to chemical ratio will be will be not worse off than a typical chemical investment plant. It will be much better than that.
Okay.
So we'll have a much better ratio than the chemical industry ratio.
Okay. 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 And secondly, sir, in terms of the South America contribution to the current revenue, which is around 4 to 5%, given the kind of opportunity which we see into the South America, I mean, how do we see this contribution in next 2 to 3 years?
I see, as I said, that a contribution I cannot comment on because it will have to be at arm's length and with China competition.
Okay.
We have to keep both things in mind. And of course, what I've said, I will reiterate that both in terms of existing products which we export already to some companies in Brazil, we'll have a great opportunity to increase the volumes of that. So, say as for example, I said chlorpyrifos. So, you know that chlorpyrifos, we are exporting around 40% of our 35%, 40% of our production. But that can go much higher because there is a huge consumption of this molecule by Sumitomo Brazil, and we can put our foot in to supply this molecule to them. And we already have the registration, so there is no issue on that. It has to be only endorsed in Sumitomo's name. That's all.
So what I can understand, sir, with this is that then there will be a lot of immediate capex requirement which will be coming because, given the capacity constraint and all. So at least if you can guide us for the next 2 years capex, that would be easy for us to.
No, we are not contemplating to increase the capacity of say chlorpyrifos.
Okay.
But there can be a capacity increase to a great extent for tabuconazole, as for example. There is another product which can go to Brazil in a much more bigger way. So if that opportunity comes, then we'll have to put up tabuconazole plant. As of today, we have only increased the capacity of our tabuconazole in our existing plant.
Got
So
that.
now we have already almost doubled the capacity of tabuconazole production from 22-23. I mean 22 April onwards, we have already put in the capacities in place. So that will help. But say overall demand of this tabuconazole keeps on increasing. There may be a need for putting up a new plant, which can be done very quickly because we are already manufacturing this product.
So you are saying that the capex requirement would not be that high that you can quantify?
No, it won't be that high.
Okay. But then, sir, in that case, you will be generating a huge free cash flow because, if I see your first half cash flow, which is around 500 crores kind of operating cash flow, and probably that much of the free cash flow which you'll be generating.
So that is good. No, that is
good.
It gives us a
So
better
I'm saying,
opportunity of inorganic growth.
Okay. Thank you, sir. Thank you.
Thank you. Before we take the next question, we request participants to please limit your questions to 2 per participant. The next question is from Prashant Biyani from Prabhudas Lilladher. Please go ahead.
Yeah, thanks for the opportunity. So has there been any discussion on checking Nufarm's LATAM portfolio which we can manufacture here? And while we have registration for 4 molecules in LATAM or Brazil, how much have we applied for in terms of registration?
Well, there are some registration which are on, but they are not because of Sumitomo Brazil. That is in a regular course of business. But let me tell you, since you have asked this question, I think on a generic portfolio, we are not that keen on registering those molecules, even if Sumitomo Brazil may be using those products. I mean, say as for example, I can give a name of imidacloprid. I mean, this product we are manufacturing in India. Sumitomo Brazil is consuming it, but we don't want to put our time and efforts in registering that product because of commercial reasons. And the registration process in Brazil is one of the toughest and one of the longest in the world. So if you are talking about any product to be registered in Brazil, it takes 6 to 7 years. And this type of molecules with smaller volume or with which are very, very generic in nature, it may not be a sustainable efforts to register those products and still find a market for them. So what we are doing is that suppose this it was told that we are looking at four molecules which are going to get off patent in 2022 and work on which have already started in our R&D and quite an advanced stage. So those, say, 2 or 3 molecules out of these 4 will definitely register in Brazil, because that will have a more sustainable life in terms of number of years that product will continue to have a demand. So we will be definitely registering those products. So say even after 5, 6, 7 years, we will have those products available to export to Brazil as and when the registrations come.
Right. So I mean, out of 4 registrations that we have, are there any registrations that we are awaiting approval, or we had applied for 4 and we have?
Tebuconazole we already have, chlorpyrifos we already have, fluroxypyr we already have, aluminum phosphide we already have. So these are the 4 products which we have already got the registration in Brazil.
Any other awaiting in the pipeline?
No, as I said, there are some which are in the pipeline, but these products are not basically for Sumitomo Brazil.
Yeah.
That we had done it even before Sumitomo acquired this company. So that process is on even much before that.
And so, with regard to this Nufarm's LATAM portfolio, how much is the commonality of product between both of us for the kind of products that you might be willing to export to Nufarm?
No, so we are looking at chlorpyrifos, fluroxypyr, and tebuconazole. These are the 3 main products which we are looking at.
And going forward, are we having any plan to start working specifically for Nufarm with respect to some products which we are not having in our portfolio currently?
No, we look at it. If there is something interesting and they want it for sure, and we can manufacture it in a very economic way or something, we can always look at it. But so far, these are the 3 largest products which they have and which we are manufacturing luckily. So, and there are 1 or 2 more molecules which we are manufacturing already, but we have not looked at registering.
Okay. And so the capex the capex plan that we will be presenting to the board, that is all relating to the molecules that we will sell to the parent.
Correct.
Okay. And any discussion with parent, with regard to, new capacities, if we can set up for catering to Nufarm's requirement?
No, not as of today, but for this one product which I mentioned, tebuconazole, that discussion we have had.
And lastly, how much was the volume growth in this quarter?
Around 4%.
Okay, that's it. Thanks.
Thank you very much. Due to time constraints, we'll have to take that as the last question. I would now like to hand the conference over to Mr. Marfatia for closing comments.
Thank you, everyone. We thank all the participants for joining us on the call today. I'm sure that we were able to answer all your queries. So further queries, if any, you may contact SGA or our investor relationship advisor, or feel free to get in touch with us at our company. We at Sumitomo group take this opportunity to convey and wish you and your family very happy and safe Diwali and prosperous New Year. Thank you.
Thank you very much.
Thank you, everyone.
On behalf of Sumitomo Chemical India Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.